I want to highlight the benefit of the higher loan limits. So everybody's talking about it. If you're on social at all, you've been seeing the fact that FHFA, which oversees Fannie Mae and Freddie Mac, they raised their loan limit, and then FHA did the same. You're also going to get the same loan limits with VA. So I wanted to talk about that from the perspective of the buyer, because why does a buyer care if the loan amounts are higher? I know we get excited as a lender and maybe even as a real estate agent, but as a consumer, does it impact me? And that's what I want to talk about today. So we're seeing interest rates lower. We're seeing mortgage purchase applications increase. We're seeing buyers take advantage of opportunities that sellers are giving them with a reduction of sales price and paying off inspection items and giving seller credits and being able to do a 2-1 buy down and a permanent buy down and all of those things. And now I got a bow on top at the end of this year, going into next year, and I want to end this live with a little bit of a forecast into what we're planning on seeing the first quarter of 2023. Now, of course, things continue to shift, and we know that Powell will stand up and give a conversation around what he sees also in 2023 and what he's going to do with the Fed rate, and inflation numbers are going to keep coming out, and China could explode again, and all the things that could happen worldwide. But right now, I'm just going to take this gift. I'm just going to take this gift and talk about, as a consumer, why do I care? And I want to run through some of these numbers with you because this is a really big deal. All right, so the conforming loan limit up until right now had been $647,200. These are random numbers. And why are they random numbers? Well, they are based on the Home Price Index by FHFA. So not jumbo loans, not portfolio loans, specifically the loans, those homes that have a mortgage insured by Fannie Mae or Freddie Mac, right, or watched and calculated third quarter every year compared to the third quarter the year before. How much did that HPI, that home price index, go up or go down? And that's how much the loan limit is adjusted. And if the HPI happens to lose value that year, then it doesn't move. Then the loan limit stays the same. So if we actually see declining home values, that conforming loan limit stays the same. But if the HPI, the home price index, goes up compared to the previous year, then we see an increase in the home limits or the loan limits. So the home price value, the home HPI, the home price index, those values of homes with loans guaranteed by Fannie Mae and Freddie Mac went up. That increase gave us higher loan limits, which gives you, the consumer, greater advantage, especially given the opportunities that we have today to negotiate a better price before we get into the spring and summer, where interest rates are expected to continue to go down, hopefully into the low to mid fives. Yes, you can refinance or do a buy down that gets you right into the mid fives. We're talking to a lot of our clients about not even refinancing, doing it once and doing it done. If you're getting a seller credit, why don't you use that money instead of a 2-1 buy down for a permanent buy down, lock in the mid fives, low fives, and never refinance, and give yourself an incredible holiday gift? That's the win. So these loan limits, so they went from $647,200 to $726,200. So the big deal here, $726,000 loan amount. That is not purchase price. That is loan amount. So you can actually, that assumes that you can put as little as 3% down on a home price larger than the $726,000. And if I do that really quickly, $726,200 divided by 0.97 allows me to get a $748,000 home and put as little as 3% down. That's a big deal because first-time home buyers have been trying to push, and you might be fully capable of affording that purchase price, but you didn't have the money to put down for a jumbo loan. So by moving the conforming loan limit, now I could get away with 1 year of tax returns or 1 year of being self-employed. We can use 1 year of variable income like hourly income or bonus income or commission income. You can have a lower credit score. You can go down to a 620. Many jumbo loans require a higher credit score. They require a 2-year history of employment. They require a lower debt to income ratio. I can go up to a 50% debt to income ratio and still get a great rate and put 3% down. All of these things allow for easier access, easier underwriting guidelines, less money down. I don't need 20% down or 10% down like I do on a jumbo. I can put as little as 3% down on a conforming. Now, in Denver, there are 17 counties in Colorado that have the high balance loan limit. And the high balance loan limit isn't the same for every single county. So for Denver, that high balance loan limit is $787,750. As an example, Boulder is $856,750. Eagle is $1,075,250. So those go up based on the HPI, the home price index for those counties. Now that's just all single family. If you're buying a 2-unit, a 3-unit, or a 4-unit as a primary home, or really as a second home, well, you can't do multi-units as a second home, but even as an investment, all those loan limits have now gone up accordingly. And I'm not going to go into that right now, but just know your loan limit on doing a conforming loan for a multi-unit, if you're going to live in a unit and rent out the others and take advantage of multi-unit house hacking, or you want to start building your opportunities for wealth creation, or you want to purchase as an investment, whether it's in Denver or another county or another state, this is the opportunity to get into those multi-units without getting into it being a jumbo. A big difference, especially on interest rates. So this is the opportunity. If I know that I'm limited to $787,750 on a loan amount, and I divide that by 0.95, that means I have to put 5% down on an $829,000 home. So I can go I can go up to $830,000, putting as little as 5% down, giving me the ability to stay inside conforming. Now, here's a deal that we're doing right now. We're helping one of our borrowers purchase a $1.1 million home. He does not qualify for jumbo. He needs to put 5% down, but we can't quite get there. But now with these higher loan amounts, we can do his first all the way up to $787,000, and then we can do the balance of the loan on a second that we have here at the Rueth team up to 95% using the same 50% debt to income ratio. This larger conforming loan limit is now giving our clients with the second loan access to higher purchase prices if they don't qualify for a jumbo loan. All of this is access. All of this is supporting affordability when we know that the higher prices and the higher interest rates have been crunching affordability. This is giving a little bit of it back, giving a little bit of options. And now, too, with interest rates coming down into the low to mid 6s, right, where you can buy down into the mid 5s, this opportunity gives you the opportunity to use the seller credit to buy down the rate, to reduce the price, to get all the inspection items, to not deal with all of the inflated demand that is coming in the spring and the summer when buyers come back, when interest rates drop, right? When inflation starts to drop and interest rates drop and people have determined the stability of their jobs and they've weathered this storm, whether it's a Fed soft landing or we go through some level of recession, depending on how quick it is, when they feel stable and secure and safe and interest rates drop, The largest age group today is 31 years old. Those 31-year-olds did not disappear. They simply signed another 1-year lease to put their ability to purchase a home on hold until those interest rates went down. And when they go down, we're going to see an acceleration of demand, providing an acceleration of home prices and that stability that we need going into 2023. Meanwhile, you got the deal. You found the seller that was willing to negotiate. You used seller credit to buy down the rate. You capitalized on these higher loan amounts so that you could put as little as 3 to 5% down. Maybe you capitalized on a second loan that brought you up to that 5%, even if you were purchasing over $1 million. You secured the home of your dreams at a price that made sense and did not even need to refinance next year, because we know that while others, in fact, LendingTree just did a survey and 4 out of 10 still think that a bubble is coming. But we know that that's not possible. We've gone through all the statistics of the incredible equity that we have in this market, the stability of 38% of all homes don't even have a loan on them, and the majority of homes that do have a loan on them are locked in under 5%. We know that supply is still, and inventory is still going to be an issue. We don't even have as much inventory as we had in 2019. We know that the largest age group is 31 years old. We know that the housing market, although will have bumps along the way, is a stable market. And so while those 4 out of 10 are sitting on the sidelines refusing to buy, you can step in, purchase a home, secure a financial stability and wealth for multi-generations, and now increase your affordability and opportunity. That's the benefit of these higher loan limits, not the fact that lenders can sit around and talk about higher loan limits for their sake only. This is for you. Nicole Rueth with the Rueth team. If we can go to work for you and help support your ability to get in today, this is the time, this is the advantage, this is the season, and if not now, set up yourself for success in 2023. See you guys soon.